Finally settled out. We got the numbers. Whew, relief rally.
Definitely relief. It shows you that I think in the early part of the week, this storyline that we were getting ever weaker economic numbers and that the weakness was not contained, I think it kind of got ahead of itself. So there was a pretty good shakeout in stocks over the course of 2 days. Market craved reassurance that the labor market was going to be okay. What I did find interesting, though, and Rick hit on it, Treasury yields really didn't budge today. So you priced in a rate cut for October. Normally, the stock market has required longer-term yields to go up in recent months for the stock market to rally. So I don't know if that means people were just very mispositioned, or it's okay because guess what? The cost of a rate cut in October was not really that severe in terms of economic pain just yet.
Yeah, unbelievable how the narrative over the last day or so. Literally yesterday morning, we're sitting there going to say it's the worst week for the market of the year. Yeah. And then you have this big reversal. And, Charlie, now we're saying it's the best day for the Dow and the S&P since mid-August. Oh, my, how things changed.
The numbers just, I don't think, were as bad as they were portrayed. The ISM service number, everybody talked about it, that being a recession number. It was actually above 50. Anything above 50 is growth.
Oh, the market started to rally at 10 o'clock yesterday when that number.
The first number came out, and the first headlines were weak, below estimates. But then when you really dig into it, it's still showing growth. And then the jobs number, not only was it a decent number with decent wages, we actually had revisions on the old numbers up more than 40,000. So I think the overall picture is, frankly, better than okay.
And Savita, it seems like you think, look, this volatility, you can kind of expect it. Look at what we're looking at and all of these different factors.
Well,
is that where you still sit here going into the weekend?
I think so. I think you should brace yourself for more. I mean, it's interesting because the first 10 days of October are actually a really interesting time for investors because three things are happening. It's quarter end. People are positioning for like the end of October, the the capital gains. And we're also positioning for year end. So the first 10 days of October, you make the most money historically by selling the most overweighted stocks in mutual funds and buying the most underweighted stocks. And that's exactly what we've seen so far this week. It's kind of interesting. You've made at least 100 basis points on that trade. And I think that that's likely to continue. It's just repositioning. I think that's what's going on.
You want to rethink, though, your note and your commentary from earlier in the week when you suggested that the gains were in?
For the S&P?
Yeah.
No, I mean, I'm still 2,900. I mean, here's the thing. What I worry about is that we're starting to see these rumblings of liquidity shocks. So we had the overnight funding rate spike up to like over 5%. I mean, and nobody seems to be worried about that. Then the week before, we had some massive style reversal from momentum to value, and then it snapped back. I mean, there's weird stuff going on, to use some technical terms.
Very technical. I like it.
But I do think that these are tells. It's kind of like what we saw in 2007, 2008, where you had the quant meltdown in the summer of 2007. Then you had, a few little like credit hiccups, some liquidity concerns, and then it was game over.
But you said there's weird stuff going on. So why don't we just simplify it?
Yeah.
Economy it's okay. It's not going off a cliff, and the Fed's cutting rates.
Well,
why fight that?
So, no, I agree. I mean, this is why I'm not bearish. I'm neutral. I think stick with stocks. They offer great dividend yield relative to fixed income. The Fed's going to be super accommodative. Don't short the market. I just don't necessarily think that right now what we're seeing underneath the surface is necessarily healthy. So that's what I worry about. Again, I think there's lots of great opportunities within the S&P 500. 60% of companies in the S&P 500 pay a dividend yield that's higher than the 10-year. I mean, that is a huge opportunity for income investors. But I do think that there are some odd little rumblings of potential liquidity risk that we need to pay attention to.
Charlie, I know you feel better than that. You feel better than sort of worrying about the weird factors. But where are there opportunities that you see? You gave us BorgWarner earlier as a last chance trade. But looking beyond a last chance trade.
So you do have to buy what others are selling. And I think value stocks are still out of favor. People talk about the S&P being at over 17 times earnings. The Ariel fund is trading for 12.5 times earnings. These cyclical names, these financials. If I told you KKR and you didn't know much about it, you'd say it's a wonderful business. It's trading at 12 times earnings. So that's, to me, a very attractive stock. So I think you have to avoid the momentum tech names and buy some names that have some cyclicality because people are still worried about the economy.
Well, I was interested today just to see the big banks rallying with yields doing nothing.
Yeah,
I mean, if you look at J.P. Morgan, in the last hour or two, it's up $1 on nothing, right? So it seems like this. not sneezing at the rally, but it seemed like there was like an upside air pocket.
Let me tell you something.
End of the day.
Banks are the most hated part of the S&P 500.
Best group in September, right?
And that's exactly what we're seeing, this positioning unwind. I think you want to stick with the banks. I think they're the new high-quality dividend yield sector.